All right. Hello, everyone. We are just getting started in a moment, but we just wanted to say hello first while we get started. And I think we are ready. So welcome to our Prosperwell Financial second quarterly market update. Presenting today will be Senior Wealth Advisor Justin Gandrud. I am Haley Kasolker. I am Prosperwell's office concierge and today's mediator for our webinar. Before we get started here, we just have a few housekeeping items for you. Number one is that this is a webinar, so the structure of it, you will be muted as we go. If you do have questions, there are going to be a lot of good discussion topics that Justin will bring up. You are more than welcome to add those questions as you feel you want them to be brought up. We have a couple features. If you look at your toolbar menu bar, it's a Q&A. If you click on that, you can type in questions. There's also a raise hand feature button, which you can toggle, and I will see that and unmute you so you can answer your question if that works better. So I will be looking at that as the presentation goes on. If you have any comments, questions, concerns, feel free to put them in those areas.
Thanks, Haley. I can run with it. I appreciate the introduction. We can probably skip the first slide then.
Oh, yep.
We'll leave it up for a moment here if anybody needs contact information, at least my email address, I should say. And there's going to be a slide at the end too that'll have some of this information. So to tell you a little bit about myself, we have the next slide here has a photo of my wife and our first daughter. We just had our second daughter 6 weeks ago, Margot. So we're a family of four, and I have new appreciation for all families of four out there, because adding the second is a new game, I'll say. So, but it's been great. Everybody's happy, healthy, just busy. So to summarize here on the next slide with what we're going to be talking about today, this is all of the slides that we're going to go through. I'll touch on a few of them, but the main ones I'm going to focus on are asset allocation, what's happening, how is that relevant to today's world, saving for retirement, some changes recently with the One Big Beautiful Bill, things we're watching out for because it is huge. So there's different aspects, and how does it affect everybody is going to have a meaningful impact as soon as next year. So I want to touch on a few things that we're watching out for. From that, college education planning also is factored into that bill. So what's currently there, what is to be expected, and what do we think might happen? And then estate planning are really my focus today, because these are some of the bigger things as we're seeing current events come up. So starting with saving and investing wisely, this is just a summary statement for anybody out there that is saving. We don't want to be gambling our way to retirement. By doing this early, it gives you better options, gives you insight and a head start. So the earlier the better, as always. When taking risks, a rainy day fund, cash savings is always important, because we don't want to be watching the market to get by day to day. Know that you're going to be okay, build the foundation, have the pieces in place that when it comes time, you have the time frame, I should say, to let money grow. And this is the best way to do it. Have a savings plan, pay off any debt. What do you need for protection to feel comfortable so that you can sleep at night? And then start maxing out 401ks, Roth IRAs, Roth 401ks, whatever it might be. So on the next slide here, the why invest, same thing. Compound interest makes a huge difference. We have a great chart of this, if anybody's ever curious, that shows the time value of money by starting at 22 or 30 years old. what's the difference of maxing out a Roth IRA? I'll tell you, if you're over those ages, it's going to be hard to look at. It's never easy, but it's things, especially if you have kids and you want them to get interested into savings. It's a great conversation for those leaving high school, college, getting into the workforce, starting jobs. We're always happy to help in those situations. And I touched on this one. We can go to the next portion here. To jump into allocation, as you invest and we invest, I should say, these are the areas that are always considered for diversifying. Starting at the top, fixed income, CDs. Fixed income also includes bonds, which bonds have not been great the last 3 to 5 years, I'll say, even coming out of COVID. We've seen the last year they've done better as interest rates have actually fallen a little bit. For example, CDs, we at one point saw just over 5% on CD rates, but we're still getting 4 to 4.3% on CDs as of today. So it's definitely worthwhile if there's cash floating out there. We don't want it sitting in a checking account or floating under a mattress somewhere when you can be earning something on it. Is always better than nothing. There's also high yield savings accounts with banks. Money market is a real thing that's paying about the same and has more liquidity. So there's a lot of options in this space that are worthwhile talking about. I'll say it's not the appealing side of the stock market, but it's definitely worth talking about in the market and current economic system that we're in. So, and there's tax advantages with municipal bonds and things like that that we can always dive into, but it's not an area to ignore, even though it's not always the headline. So, international funds right now have done very well this year. They're up substantially. And there's a few factors to this, and it's a lot of speculation, I'll say. It's people wanting to be invested outside of the US and concern of the US dollar. Both of which we see as speculation. So if you have money invested internationally, it's not a terrible time to look at, should we dial that back? How much do we want? And what parts of the country is it in? Is it developed and non-developed is a technical term that we see a lot of. Just like it sounds, most of Europe is developed, countries that are developed, and then there's third world non-developed countries that are substantially riskier to invest in, but with that risk can also come higher returns too, is the expectation. So jumping into small cap, this is typically 10 billion in revenue or less. There's also considered an ultra small cap now. I'll touch on private equity here under specialty investments. But small cap, when a lot of people see that, they think small companies in the eyes of the average investor. A small company is still a very large company at the end of the day. The two Minnesota ones I like to pick on are Polaris and US Steel, which actually just got bought out. But in my eyes, those are both huge companies. In the eyes of investing, they're actually considered small cap companies. Mid cap is typically 10 billion to 35 billion in revenue. So same concept, still very large companies that are worth investing in, but because they're not as established, we expect higher returns by taking on a little more risk. There's a time and a place for both of these. And then large cap, growth and value have really been the topic of discussion the last few years. This is the S&P 500. The large US companies, they're actually calling the Magnificent Seven, which is Apple, Amazon, Google, Tesla, NVIDIA, Microsoft, and Facebook. They're actually calling them the mega cap or ultra large cap, but this still falls under large cap. The difference between growth and value, and this is true for mid-sized companies, small-sized companies, international, all these pieces have growth and value proponents to them, I'll say. Growth tends to be companies that don't pay dividends and want to be growing. Or if they pay a dividend, it's very small. Value companies tend to be value-based. Xcel Energy, as a Midwesterner, is a big name that energy companies don't want to show a 50% return. And if you're paying the energy bill, you know that you don't want to see a 50% return. So their goal is to pay a dividend. They want to be consistent. They're growing at a common rate. This is value investing, is buying companies that are going to pay dividends, and their goal is to be that consistent, rain or shine, this is what we're going to earn type of company. So I know this is getting very technical. I will keep it high level, but I'm always happy to help answer any questions. Specialty investments, this is a growing industry, I'll say, or a growing thing. We've been using a lot of these types of investments. One of the areas that we've used the most of are things technically called buffered ETFs, structured investments. There's a wide variety of these, but really what all those mean is it's options hedging against different types of investments. I like to say it's bowling, it's investing with bumpers. So it's a way to know you're in the market, you're not missing out on upside, but how do we protect against some of that loss? There's a time and a place and a person for this, depending on what you're looking for. The other area that's extremely common right now, or a hot topic as well, I should say, is private equity. There's good and bad with private equity. It's growing so fast that we want to be very cautious and know the repercussions and the risks of what this means. Typically, private equity is illiquid. So that's the first thing we always talk about is if you go into private equity, the goal is 5 to 7 years before you even might have a chance at getting this out. And so it's not an all or nothing. There's a very meticulous time and place, and it's not something to dive into head first. We want to tiptoe into the water on this. Just like with stocks and bonds, there's varying degrees of companies, investments, how aggressive do you want to be, things like that. So likely it sounds like actually as of today, there's another bill being signed into place that private equity is likely going to become even more of a hot topic and become more of a talking point, I should say. So as you can tell, I can talk about this in the market all day if we wanted to. I think it's very important, but it's the appealing side to our job. The more important side a lot of times is the planning portion. So jumping into the next pieces, this is a portion to the puzzle, but we want to make sure investing is within the realm of what somebody's looking for and fits their situation. I mean, if you're 30 years old or 80 years old, likely you're not looking at the same investments. So know your credit, annualcreditreport.com. The best thing to do is look at this in a free manner and make sure that you're not dinging your credit. There's a ton of different sources out there. Credit in general is not talked about enough in our eyes. Here's just a graphic makeup of how they actually calculate this. A very common question we get to say what makes up your credit score. And the goal of credit is that you're using it to borrow things that are going to grow in value, like a house. But at some point, as you get older and closer to retirement, we don't want everybody using their credit score either. And that's where you see people with a perfect credit score, but it doesn't really matter because they don't need to borrow money anymore, is the goal in life. So moving on to the next slide, a budget worksheet, again, can be very boring. We want to make this as fun as possible, but at the end of the day, it's checks and balances of what's coming in versus what's going out. We have a budget worksheet that we're happy to send. It covers the ins and outs. I think dog food is on the list. So it's not something you're going to do monthly. It's to do once and say, where are we at and how do we get this down? And what's the best breakdown for our household in deciding what this looks like? How do we track this to make it as painless as possible and know that there's more coming in than going out every month? again, we have a lot of strategies with this that I'm happy to dive into, but saving for retirement, I touched on this early on, but it's really a matter of what accounts, what buckets, what makes the most sense for your type of company. In general, general rule of thumb, make sure you have a savings account first. You have to get by day to day. Then the next step really is adding to your 401k to make sure, especially if your company gives a 401k match, we want to make sure you're putting in at least enough to get that 401k match. For an early investor, then we start to look at Roth IRAs. So make sure you get the match, then look at a Roth IRA. Once you've maxed out those two, we can go back to your 401k and start to max that out as well. And so it's putting money aside, but there's also tax benefits, whether it's now or later with the different types of accounts. So there's a reason and a time and a place for all of them. Some of these names on the bottom left-hand corner probably look familiar, but a 401k, 403b, 457 are just different types of tax codes, honestly, for very similar accounts. SEP, simple IRA, and single or solo 401k are all small business owner types. If that's something you fall into, let us know. We're happy to help with what these mean and why you might choose one over the other. Roth and traditional IRA, just to give the explanation again, a Roth IRA is not a tax deduction when you put the money in, but later in life, it's all tax-free. So think of this as cash out of your pocket. You're putting it in, you're not getting a deduction for it on the front end, but later in life, when you take it out, it's all tax-free. A traditional IRA is very similar to a 401k that if you put the money in, you actually get a tax deduction in the year you contribute. There is income limits to this, so you always want to be careful before adding to a traditional IRA that your accountant is in the know of what you're doing. But this is a tax deduction on the front end. So later in life, when you go to take the money out, it is taxable as income. And then rollover IRA is just an old 401k or 403b or 457 that you can move into an IRA if it fits your situation. Retiring at work, here is exactly the graph that I just explained, but make sure you get the match, max out your retirement plans. That includes a Roth IRA. That's where a Roth IRA comes into play. And especially with bigger corporations, employee stock option plans, there's different RSUs. There's a ton of different abbreviations for this. ESPP is a purchase plan. They're good for situations. We don't want all your money invested in one place. They're the analogy I like to say is if you're invested too heavily in your company, if you think about life in general, zooming out a second, a lot of people are triple leveraged, I'll say. They call it over triple leveraged, which means you have your income coming from one job. Your house is a large asset. So these are two individual things. You have your income coming from one place. You have a lot of money put into your house. And you have an employee stock option plan or some sort of work plan where you're getting company stock. Your retirement can be heavily based on one company. So now you have one income, one house, and one company investment. It can work out really well for a lot of people, but it can also hurt a lot of people. For example, Boeing is the one I like to pick on coming into COVID. They had the unfortunate perfect storm that stock fell about 75%. Boeing is a company that their employees have a ton of company stock typically. So if you had $1 million in Boeing, that $1 million that you were planning to retire on just fell to $250,000. And that substantially changes somebody's life. So we want to take advantage of those things when they're out there, but be very cautious of where are we actually, how risky is this for what I want to do in life. And actually the next slide here I explained as well already, the difference between Roth and traditional IRA. Currently, it's $7,000 for anybody 49 or under. You can put up to $7,000 a year into. Over 50 or over, I should say, you can actually add another $1,000. So the limit is $8,000 per year per person. And actually, this is just more of the ins and outs of Roth and traditional IRAs. We can go over these, but we're always happy to help send these. Actually, the one note I wanted to say was on traditional IRAs, you do have to, that bottom bullet point there, well, I'll say the bottom two, you have to be 59 and a half to pull from this without very specific instructions, I'll say, where it's not penalized. So it's still taxable, but if you take it out before 59 and a half, there's typically a 10% penalty plus taxes. And if you're working, all this goes on top of your ordinary income. So it's really not an account we want to pull from. Like I said, there's specific reasons that you can actually take out early, but it's very qualified and spelled out specifically within the government and IRS rules. Required minimum distributions, typically you'll see this as RMDs. It used to be 70 years old. Now it's 73 that the IRS says you have to take money out of an IRA or 401k that is a tax deferred account. So every year it gets a little higher. We help all of our clients make sure that you don't get penalized by missing an RMD per year. So before 2033, as it sits right now, this number is expected to go up to 75 in the near future. And now I'll actually let us go past these Roth and traditional slides. A lot of times this is when we start to talk to somebody is a change of job, a passing in the family, some sort of life event that comes up, and it typically is what sparks that conversation or gets somebody to not necessarily just think about money, but to actually take action on it. As you can imagine, we push everybody to think about it more often than you think, because by doing the right things, slowly, steady, consistent, makes a big difference. It gives you choices. By talking about the things that you don't necessarily want to, can always benefit you in the long run. Making sure that beneficiaries are on accounts is huge. It's scary how often we see accounts don't have beneficiaries when it's just putting the name on there. Even if you're not sure, you can have a default, talk about it. You can always change these numbers. Divorce as well. It's never a fun situation. Nicole in the office here is a certified divorce financial analyst. So we work with a lot of these situations. Everybody's is different, and it isn't always the easiest conversation, but it's something that has to be done and has to be had. And how money falls into this, as most of you know, can make a huge difference on how that process goes. So the last note I'll mention is an IRA conversion. So there's a few different options of this. This can reference a few things, I should say. A Roth conversion is a big buzzword out there right now. It's something we do all the time for the right situation. It's not an everybody should do this tomorrow. There's a time and a place that Roth conversions can make a ton of sense. So college education planning, 529s are really becoming the go-to for this area because rules are loosening for 529 plans in areas that UTMAs, UGMAs, or Roth IRAs are not. They're not out of the picture, but there's a lot more benefit to a 529 plan at this day and age than there was 5 years ago, I'll say. What those benefits are is it's always a 529 plan in and of itself is meant for college. So parent, guardian, grandparents can open these for siblings, grandparents, anybody, any family relative really can own a 529 plan for somebody else. And the owner always has control of it until they decide to use it for college or transfer it to somebody else's name. One of the biggest rules that we really like that changed with this a few years ago is that money can be transferred to a Roth IRA in the beneficiary's name if it doesn't get used for school. It's up to $35,000 per year. We'll see what the government decides to do with this new information. So part of the big beautiful bill was that there's different names for them, but the Trump accounts, the kids that are born from 2024 to 2028 here, it'll be interesting to see how this plays out, but the expectation is there's $1,000 being put into an account. When they turn 18, they can use it for college, car, starting a business. I shouldn't say car. It's really starting a business, paying for college, getting off on their feet. With this introduction, we're waiting to see how it plays out and what this is actually going to look like, because I assume it's going to change some of the rules or even loosen things more around 529s. So we'll see how all this plays out, but it's definitely something we're watching out for to see what this looks like. The one downfall is the new Trump accounts, I'll say, are they do have a limit on how much you can put in. As of now, it's expected that you can only do $5,000 a year, where a 529 you can do substantially more per year. Estate planning, I will keep it as short and sweet as I can. This is getting more and more important every day as this generational wealth transfer that has been talked about forever is starting to come to fruition, honestly. We can see why and how as everybody's day-to-day is being transferred. There's a lot of money that's going to be changing hands. So it's making sure that things are set up correctly, that and you never know what's going to happen. So God forbid if something happens sooner than expected, we want to make sure everybody has the pieces in place so that money doesn't cause more of a problem than it already can. I like to say the average saying of, if I had $1 million, I would do X, Y, or Z, is always a thought until you have $1 million, and then you never want to lose it. And so when people come into an inheritance, if they're going from 0 to $1 million at the drop of a hat, there's a lot of conversation and context that we want to make sure not only it doesn't cause family controversy, but that everybody knows the same understanding, the same mindset. What does this look like? It's something to talk about, because having a plan is one of the most important things you can do. Getting family and friends or anybody that's involved, whether it's a power of attorney, siblings, anybody that's listed, you really want to make sure that the expectation and the reasoning behind it is there, but also the legal documents that show this is how I want my assets transferred. So insurance is not something to overlook. This can be life, long-term care, disability, all of the above. We have some great documents on all of this. One that we really like to share is called the legacy document. It's not a legal document, but it's a good thing to write down and say, if something happens to me, here's where everything is. We've had clients put on Facebook passwords, bank accounts, anything and everything you can think of. Pets, I mean, whatever documents are out there, this is really to say, I want somebody to know where this is and put it in a safe or some safe place that whoever would have to deal with it knows where things are and who to call. How to choose a wealth advisor, things to watch out for. It's a financial advisor, financial planner. There's a ton of terms for this out there right now. Make sure somebody's independent. They're not selling one product. This is also considered a broker, I'll say, to some extent. Unbiased advice. Make sure you know how they're getting compensated and what they're looking for, because you don't want somebody earning commission or selling something, I should say, that's only there to benefit them. Fiduciary term that we hear every day. We are fiduciaries, but be sure to ask the question, what does that mean? Really, the difference is that a fiduciary is continually doing what's in your best interest. So, financial planning focus, as even though a house is not an asset that we can manage or oversee, we want to know what's out there for all the reasons we just talked about. Shop around, make sure you know your options, who you're working with, what makes you the most comfortable, and ask those questions that keep you up at night. We would rather have the conversation than have somebody assume something that may not be right. So, here's just a list of the things that we went over. Asset allocation is a big one, where we're saving, what part of the market makes the most sense for the economy that we're in today is something that is very relevant as everybody watches the news today. So no one has the crystal ball to know what's going to be the next home run. And that's why diversification is a real thing. We want you to be spread out, so it's not always a all or nothing play. Know your credit score, save for retirement, college education is there's good options out there that'll likely be getting better here in the near future, but there's a lot of moving parts with it. Estate planning, have your pieces in place, and then picking a wealth advisor, talking to somebody, getting the right advice that fits your situation makes a big difference down the road. So I'm going to stay on for questions. If anybody has any for a few minutes here, we're more than happy to help. There's a QR code here if you ever want to schedule a meeting with us. We run a free, no obligation first meeting to see who we are, how we work, are we the right fit? So if you're still here, thanks for hanging around. We appreciate it.
Thank you, Justin. And as he was saying, we do have all of those resources that were mentioned, such as the budget worksheet. We also have different resources available specifically for people going through divorce, people starting a business. We have different guides that are available on our website at prosperwell.com. The QR code is if you are interested in scheduling that no cost obligation consultation with us to meet with Justin or one of our other team members, you can certainly use that, or you can always email us. Our number is listed. We also have some just upcoming events, golf tournament on August 18 at the Wilds in Prior Lake. We host a monthly Prosper Wine and Women, which is a female networking opportunity for other business women in the area. So our August one is the 20th. And we have another webinar series for Social Security that is held on a semi-quarterly basis, the next one being August 27th. And then our next time with Justin here for quarterly market update, quarter 3 will be November 13. So all of those events, again, are also available on our website at prosperwell.com. And with that being said, I don't think we have any questions, but thank you so much for joining us. And again, as Justin said, we are always here, happy to answer any questions. Feel free to give us a call, send us an email. Thank you so much.
Thank you.
All right.